These are the accounts extracted from the ledger of Julie's business. Julie sells sports shoes. I'm going to show the effects of several transactions that happened in the month of March on the ledger accounts, and then prepare an adjusted trial balance as at 31st March. The total debit and total credit of the trial balance must be equal, otherwise errors must have occurred. For each transaction, analyze the effects, namely, add or subtract the amount on the relevant affected accounts using the double entry rules. All workings must be shown adjacent to each affected item. In the month of March, the following transactions took place. First transaction, bought a computer 2000 on credit. We will analyze this transaction using the double entry rules. Computer is a type of office equipment. It is an asset. So, when a business buys a computer, office equipment increases, so we debit. On credit, in other words, there's no payment yet. As this business sells sports shoes, computer is not inventory, so we cannot use trade payable. The correct account name is other payable. So the business actually owes more to the business selling the computer. Liability goes up, we credit. Okay, debit office equipment, it is to add to the account office equipment. Credit other payable, this is a liability which also increases, we add. Second transaction, returned some defective goods amounting to 300 to a creditor. A creditor is a trade payable. Returned goods. Goods is inventory. Now this one, the trade payable is a liability. It is reduced since you return goods to the trade payable. Therefore, liability goes down, we debit. Now, when you return goods, inventory goes down. So the account name inventory, which is an asset, is reduced. Therefore, we credit. Debit trade payable, we subtract. Credit inventory, we also subtract. Received 800 check from a debtor, trade receivable for amount owed. The transaction, receive 800 check. You see the word check, it affects the cash at bank. So cash at bank goes up. It is an asset, therefore we debit cash at bank. Since you receive the money from a debtor or trade receivable, the amount owed by this debtor is reduced. This is an asset. Asset is reduced, therefore we credit. Debit cash at bank plus credit trade receivable, we minus. Julie took out cash 100 to pay for her personal groceries. Julie is the owner. She took out cash $100. Cash is cash in hand. for her own use, personal groceries, for her own personal groceries. So this is drawings. She is taking out more assets from the business. This asset is inventory because this asset is cash. Cash goes down. She draws out things for herself. That is drawings. So drawings go up. You debit drawings, and you credit cash in hand. Asset comes down. Debit drawings is plus, credit cash in hand is minus. Now you have analyzed the effect of each of these transactions using the double entry rules.